Most Canadians are paying penalties they could have avoided. I'm talking 15, 20,000, 30,000 sometimes, even more in penalties that didn't need to happen. And it's not because they made a bad decision, it's because nobody told them how mortgages actually work. Hi, I'm Dion Williams. I'm a mortgage broker here in Canada. And in the next 10 minutes, I'm going to break down everything you actually need to know about getting a mortgage in Canada. Not the sanitized version the banks give you, but the real version. Look, if you think a mortgage is just like a car loan or a student loan where you borrow money, make payments, and you're done in 5 years, you're already starting from the wrong place. Mortgages don't work that way. And the banks, they're counting on you not knowing the difference. Because when you don't understand how mortgages are structured, you end up locked into products that benefit them and not you. But here's what they don't tell you: the biggest mistake Canadians make isn't choosing the wrong rate, it's not understanding the difference between your mortgage term and your amortization. And that one gap in knowledge, that's what costs you. But here's the truth the banks won't say out loud: your mortgage term should match your life plan, not the bank's sales quota. But most people walk into a bank and they get pushed into a 5 year fixed, not because it's not right for them, but because it's easy for the bank to sell. Let me show you exactly how this works so you never fall into this trap. All right, let's clear up this for once and for all. Your amortization is the total time it takes to pay off your entire mortgage, usually 25 to 30 years. Term, that's how long your interest rate and your mortgage contract are locked in. It could be 6 months, it could be all the way up to 10 months. Here's the key: your mortgage isn't paid off at the end of the term, you're just renewing it. So if you've got a $400,000 mortgage with a 25-year amortization and a 5 year term, at the end of 5 years, you still owe around $340,000. You're just renegotiating the terms for that next chunk. Now, here's where it gets important. If you've got less than 20% down and you're not a first time home buyer, your max amortization is 25 years. If you've got 20% or more down, you can stretch it to about 30 years. But here's what nobody tells you, and this is critical: the term you choose should match how long you're actually going to be in that house. When you get this wrong, it costs you. Let me give you an example. I had a client, let's call her Sarah. She bought a condo in Toronto. She had a good job, solid income, first time buyer. The bank put her in a 5 year fixed close at 3.5%. Standard stuff. 2 years later, she gets a job offer in Calgary. Amazing opportunity. She has to move. She calls me and says, Dion, what's it going to cost for me to break this mortgage? I ran the numbers. The penalty? $22,000. Yes, $22,000 just to get out of a mortgage she'd only had for 2 years. Now, if we had structured that mortgage from the beginning, if we'd asked the right questions up front: how long are you planning to be in this place? We could have put her in a shorter term or an open mortgage. She would have avoided the entire penalty. But the bank didn't ask that question because, truthfully, they don't care. They got their sale. This is why the first question I ask every client is this: how long do you think you'll be in this home? Because if you're planning to be there 2 to 3 years, a 5 year fixed closed mortgage is a trap. You need something shorter, something flexible. So let's talk about open versus closed mortgage, because this is where you get flexibility or you get locked in. Open mortgages, you can pay it off at any time you want. No penalty, total freedom. Sounds amazing, right? But there's a catch. The interest rate is going to be higher. sometimes a full percentage point higher. Open mortgages are for people who need a short term financing. Maybe you're going to be selling soon, or maybe you're waiting on an inheritance or a business sale. You're not staying in this mortgage long. For most people, you don't want an open mortgage long term because you're paying a premium for that flexibility. You may not even use it. Closed mortgage, it's where you're locked in for a term. It's got a lower interest rate, but if you break it early, you're paying a penalty. Most Canadians should be in a closed mortgage if the term matches how long you plan on staying. That's the key. If you're staying 5 years or more, a closed 5 year fixed or a closed 5 year variable makes sense. If you're staying 2 to 3 years, you want a shorter term or negotiate better prepayment options. Now, here's where it gets even more interesting because once you've figured out your term, you've got another big decision to make: fixed or variable. And this is where most people get it wrong because they're making an emotional decision instead of a strategic one. Let me break down what actually matters. A fixed rate mortgage, it's where your interest rate stays the same for your entire term. It's predictable, it's safe, no surprises. You can get a fixed rate anywhere from 6 months to 10 years. A variable rate, that's where your rate moves with the Bank of Canada's prime rate. It's usually prime plus or minus some type of percentage. Now, here's what the banks won't tell you. Over the last 30 years, variable rates have saved Canadians money more often than fixed. But banks push fixed rates harder. Why? Because fixed rates are easier to sell, they sound safer, and when you break a fixed rate mortgage early, the penalties are way higher. That's where the banks make a profit. With a variable rate, if you break it early, it's usually almost always just 3 months interest. With a fixed, you're looking at an interest rate differential or an IRD, and that can be massive. Remember Sarah? $22,000 penalty? That was an IRD calculation on a fixed rate. If she had been in a variable, her penalty would have been around $3,500. That's the difference. Now, I'm not saying variable is always better. It depends on what's happening in the market right now. But what I am saying is this: don't let the bank make this decision for you based on what's easiest for them to sell. You need to look at where rates are today, where they're likely going, how long you're staying in the house, your risk tolerance. That's how you make a smart decision. All right, so you've picked your term, you've decided between open and closed, you've chosen fixed or variable. Now, here's the part most people completely miss. This is where you can actually save years off your mortgage and tens of thousands of dollars of interest. It's called prepayment privileges, and almost nobody uses them because they don't even know they exist. Most mortgages, whether fixed or variable, open or closed, come with prepayment options built in. And here's what you're usually allowed to do: a lump sum payment up to 15% of the original mortgage amount once a year with no penalty. You're able to increase your regular payments, usually 10 to 20% more than your original payment. Now, let me show you why this matters. I had another client, let's call him Marcus. Marcus had a $350,000 mortgage, 25-year amortization, 5 year fixed at 4% interest. His regular payment was $1,850 a month. I told Marcus, if you can afford to bump that payment up by just $200 a month, that's it, just $200, you'll shave 4 years off of your mortgage and save over $35,000 in interest. He did it. 4 years later, he's already seeing the impact. His mortgage balance is way lower than it would have been. He's building equity faster, and he's on track to be mortgage free in his early 50s instead of his late 50s. That's the power of prepayment privileges. But here's the thing: most people don't use them because They don't know how to use them, or they don't think $100 or $200 a month makes a difference. It does. It makes a massive difference. So let's bring this all together for you. Because if you want to set up your mortgage the way that actually serves you and not the bank, there's a framework. I use it with every single one of my clients. I call it the freedom blueprint. And it's built on one simple idea. Your mortgage should be structured around your life goals and your wealth building plan, not what's convenient for the bank to sell. Here's how it works. Step one, match your term to your timeline. Don't lock into a 5-year fixed if you're moving in 2 years. Don't take a 10-year term if you're planning to upgrade in 5. And ask yourself, how long am I realistically going to be in this house? Then structure your mortgage around that answer. Step two, understand open versus closed. Most people should be in a closed mortgage, but only if the term fits your timeline. If you need flexibility, pay for it strategically with an open mortgage for a short period. Step three, choose a fixed or a variable based on a strategy, not fear. Variable gives you flexibility with penalties. The fixed gives you predictability. Look at the market, look at your situation. Make the call based on data, not emotion. Step four, maximize your prepayment privileges. Even an extra $100 to $200 a month can save you years and thousands in interest. Use your lump sum payment options every year if you can. Increase your payment when you get a raise. This is how you get to be mortgage free faster. And step five, work with someone who understands your goals, not someone who's just trying to hit their sales quota for the month. You need someone who's going to ask the right questions up front. Someone that's going to structure your mortgage around your actual life, not the bank's product lineup. And here's the line I want you to remember. And I want you to share this with anyone who you know is getting a mortgage. Your mortgage term should match your life plan, not the bank's sales quota. That's it. That's the whole game. If you remember nothing else from this video, remember that. All right, look, if you're in Canada and you're looking to get a mortgage, or you're coming up for renewal and you want to make sure you're not leaving money on the table, I'd love to help you. I work with Canadians all across the country to secure mortgages using this exact blueprint. So if you're not stuck, you're not overpaying, and you're actually building wealth instead of making payments. Click the link below to book a free mortgage strategy session with me. We'll go through your situation, figure out what makes sense for your timeline and your goals, and make sure you're set up to win. No sales pitch, no pressure, just a real conversation about what actually is going to work for you. And if you found this helpful, do me a favor. Hit that subscribe button and drop a comment. And let me know, are you team fixed or team variable? I read every single comment and I'll reply to as many as I can. Also, if you know someone who's about to get a mortgage or renew, send them this video. It could save them thousands. All right, that's it. Let's get you set up with the right mortgage. See you on the next one.